Hello and welcome to our presentation. We are Group 1 and today we'll be covering IAS 41, which is primarily related to agricultural activities. So what do we use IAS 41? Well, imagine if you have a guard dog at farm and you think that IAS 41 applies here because the dog is a living animal. But guarding is not an agricultural activity as defined under IAS 41. It comes under ACCT 16, so the counting of dog is done under that. But before we move on to other criteria, first let's look at some definitions. I'm going to just explain these in simple words. Agricultural activity is just related to the management, biological transformation, and harvest. An example of it would be catching a wild fish from the ocean, which is not an agricultural activity, but running a fish farm is. For biological assets, it's a simple definition which requires a living plant or an animal, but it doesn't have an exception, which we'll see ahead. Agricultural produce. This is the harvested product from the agricultural activity. Examples may include apples from an apple tree, and for biological transformation, it is the process of growth, degeneration, qualitative and quantitative changes of biological assets. So we can think of it as the production of cheese, how it's milked from a cow and then turned into cheese. Scope of the IAS 41. IAS 41 prescribes treatment for biological assets as discussed before, but the exception is plants, which we'll look further. It also applies to agricultural produce, but only at point of harvest, and for government grants, only related to agricultural activity. IAS 41 does not apply to land that comes under IAS 16, property, plant and equipment, or IAS 40, investment property. It also does not apply to intangible assets related to agricultural activity. That's IAS 38. It doesn't apply to plants, which comes under PPE, property, plant and equipment, or related government grants, or post-harvesting processing, which is inventory IAS 2. So what's the difference between biological asset and plants? Biological asset means living animals or plants managed only for agricultural produce or harvest. Sale of biological assets or additional biological assets. But plants, according to IAS 16, is the use in supply and production of agricultural produce, expected to bear for more than one period or remote likelihood of being sold as agricultural produce. An example maybe think of it as a tea bush, a mature tea bush. The bush itself is a barrel plant as it will produce more tea leaves in another period. But the tea leaves are considered a biological asset because they are considered harvest of that waste produce. Now let's move on to recognition and measurement.
So I will be discussing the disclosure requirements under IAS 41, which is agriculture, and providing a brief explanation of how this impacts financial reporting. So IAS 41 is the international accounting standard that actually deals with agricultural activities. It applies to biological assets. This could be like livestock, crops, forests, or even agricultural produce. And the main objective of IAS 41 is to improve transparency and comparability when it comes to financial reporting. And this is done by requiring very detailed disclosures about the biological assets and how they're measured. So IAS 41 requires biological assets to be measured at fair value less the cost to actually sell the asset. Because of this requirement, entities need to disclose the valuation methods that they used and assumptions that they've made. And if there's no active market price for the biological assets, then entities need to explain how the fair value is estimated. This could be through like various different models, discount models, or based on comparisons in the market, but it would need to be disclosed. And one of the most important disclosure requirements is the reconciliation of carrying amounts. This means that the entities need to show how the biological assets actually changed during the reporting period. The changes could include additions, reductions. Additions could be from purchases, reductions could be from like sales or even harvest, and also changes in fair value. So IAS 41 also requires disclosure of gains and losses. This is very important because changes in fair value are recorded directly into the income statement, even if the asset hasn't been sold yet. And this is one of the reasons why agricultural entities tend to experience significant earnings volatility, depending on the market price and the biological experience. Another fact about IAS 41 is that it encourages disclosure of non-financial information, such as this could be like the number of livestock, number of acres, or quantity of harvest that's produced. And these physical disclosures are there to help the user of the financial statement actually understand the operational performance better and not just the financial figures. Also, entities need to disclose any information when it comes to biological assets that are pledged as security or any commitments for future agricultural development, as well as any government grants that were received or taken. So my overall views, there's both strengths and limitations on this. On one hand, fair value does provide relevant and up-to-date information that reflects like the current market's conditions. But if you look at it from the other side, there's also it could reduce reliability because the valuations are depending on estimates most of the time when there's no price in the active market for those assets. So IAS 41 does improve transparency by requiring very detailed disclosures on biological assets, valuation methods, as well as the financial performance. However, I think the reliance on fair value brings on other challenges and uncertainty that's related to reliability, earnings totality, and subjectivity.
So looking at government grants. So we already looked at how plants are valued at fair value, but we need to talk about how agricultural companies manage their finances beyond just selling crops. It's very common for firms to receive government grants, which are extra money. So they significantly impact the timing of income recognition. Look at a big difference between a company's reported profit and its actual performance. So understanding when these grants hit the income statement is the first step judging a company's true financial health. So looking at how it impacts the financial statement. So the government gives out two grants. So there's an unconditional grant, which is simply being recognized when it's a profit or loss as soon as it's received. And the second one is a conditional grant. So you have to wait and defer the income until specific conditions, like meeting production targets are actually met. So the important concept here is the volatility. So a one-time subsidy can make a company look much more profitable in a single quarter than they actually are. It's necessary to look at the nose and separate the grant income from the operational earnings. So we can see if the company is succeeding through its own business or because of the government help. So the TXS company that we decided to go with is Aurora Cannabis. So they are essentially a major Canadian licensed producer in highly regulated agriculture industry. So they grow their products. They use advanced controlled indoor and greenhouse facilities. So the core business and the reason for their reporting is so interesting. So their primary assets are biological. This includes the cannabis plants that are various different growth stages at any given time. This operational setup is the reason why currently we were discussing because inventory is living. They require a specific standard to measure the inventory. So how does this apply to IAS 41? So they use fair value less cost to sell model. You have to look closely at the market and the price assumptions and production cost estimates because these are based on management's own estimates the future returns. Because these are based on management's estimates, it can become unrealistic because the management could be too optimistic in how well they think it's going to do. So we gotta estimate it based on the reasonable price. So looking at an example from the actual financial statements that I screenshotted. So no 5, they use IAS 41 to measure the value of the plants while they're growing based on fair value. So this is subjective and it essentially creates an audit risk. It relies on the management's guesses about future yields. However, once they're harvested, they move into inventory and measured at the lower of cost or net realizable value. This shifts from fair value to historical cost. The lesson here is to look at both notes to understand the full story of the financial statements and how they came to the valuation. So by understanding the shift, you can see if a company is truly transparent or if they're using an accounting estimate to inflate their value.
So overall, IAS 41 kind of improves transparency because the companies are now using fair value instead of just historical costs. So it gives them more of a current picture of what biological assets are worth in that time. But at the same time, it's not perfect. A lot of these valuations are okay. Now we're moving on to the conclusion, everyone. So overall, IAS 41 kind of improves transparency because the companies are now using fair value instead of just historical costs. So it gives them more of a current picture of what biological assets are worth in that time. But at the same time, it's not perfect. A lot of these valuations are honestly not that straightforward. Like depending on the asset, there might not even be a clear market price. So company kind of have to rely on estimates. And because of that, you can get a lot of fluctuation in earning from year to year. So even if the actual operation, didn't change that much, it still can affect the valuation and still cause a lot of fluctuation. So just to rewind, both of the companies that we covered today, Maple Leaf Foods and Aurora Cannabis, you can kind of see how IAS 41 plays out in real life in very two different ways. Maple Leaves is more straightforward because it rely on livestock of the market prices, so the valuation is a bit more grounded in the actual market data. But when it comes to Aurora Cannabis, it's a little bit more complicated because it depends on estimates. Like it expects growth stages and their future selling price, which is something that is a bit more estimated than knowing definitely what it's going to be. So even though both companies are using same standard, the way it gets applied to them is quite different. As we could see that in both of these companies and depending on the industry as well. So to wrap up everything, IAS 41 is useful because it gives more up-to-date information about biological asset, but it definitely comes with a challenge. A big part comes to the judgment. Companies have to make a lot of assumption when they don't have a clear market value. So I think the biggest takeaway is that you can't just look at the numbers on the financial statement. You really have to look at the disclosure notes to understand what's behind those numbers and how they're calculated. Overall, IAS balances relevance and reliability. Thank you so much, everyone, for watching.